Alright then, good morning folks, as we are a little bit out from European trade on Thursday the 26th of October. Now we'll have a look across markets and see what is going on as the moves that we've been expecting since the start of the week have kicked into gear. We've got stocks lower, dollars higher and yields higher as well. Sorry, not the kind of reason we thought. I mean, earnings, we had some of the big hitters out. Alphabet, which is obviously Google's parent company, decent earnings apart from cloud growth or growth in their cloud sector missing analysts' estimates, which is not what markets have been hoping for, especially the fact it's a tech company. At that sort of sector, the tech companies would ideally like growth in that sector to be strong, to be positive with the wave of AI and all that sort of the jazz. So the fact that missed analyst estimates, Alphabet, their worst session since 2020, down nearly 10% in yesterday's trade. So that helped to drag stocks lower. Meta moved lower as well. Earnings and stuff was okay, but a cloudy future outlook was looked at by traders as a bit of a negative, and the stock price sold off the back of that. So yeah, okay, earnings are okay, but cloudy outlook with expenses high caused the stock to sell off, and they are two big hitters when it comes to the stock indexes, and they helped to drag stock indexes lower yesterday. Right, that is then solidified by the move higher in yields. We had a weak bond auction yesterday, which weak bonds, lack of demand for bonds, again sends the yield higher as well, which puts further pressure on stocks. The US dollar also moving higher with yields further puts pressure on stocks. So negative day yesterday all around. Sentiment sours. Australia and New Zealand dollars were hit along with that on souring risk, even though you had strong inflation figures out of Australia yesterday, which did tilt the balance towards a rate hike at their next meeting in November. But the new governor, Michelle Bullock, did come out and sort of pour cold water, and that was what the central bank had expected, and they are unsure as to whether that does warrant a rate hike. So imagine Australia, the Australian dollar on improving risk sentiment, on positive risk sentiment, will probably have a pop higher. The balance of probabilities slightly tilted towards a rate hike now after a solid number of 4 or 5 pauses in a row with their central bank, with their interest rate decision. So if risk does start to improve, the Australian dollar seems a decent buy. They're selling it off the back of risk. New Zealand dollar is probably a better way to go. Interesting thing overnight though, the Japanese yen weakens to 1 year low amid intervention nerves. Dollar yen is above 150 and aggressively above 150. So we will watch that with a keen eye to see if there's any intervention from the central bank. Oil down slightly, or oil up slightly yesterday, should I say, up 2%. Some jitters around the Middle East. Israel's Prime Minister suggested that they are going to launch a ground invasion in Gaza, which heightens tensions, which is a bit of an escalation. Ultimately, is that a long-lasting thing in markets? You have to imagine probably not. Probably contributed to some downside in stocks, but it's different to the Russian-Ukraine situation. When Russia and Ukraine happened, like Russia supplied Europe and a lot of countries with a lot of oil and gas. As soon as Russia went into Ukraine, economic sanctions are slapped on Russia, and then there's less supply of gas, there's less supply of oil, there's less supplies of commodities, some foods and stuff like corn, for example, and that causes the price of all of these commodities to rise, and then that has widespread effects across financial markets. It's not just confined to that part of the world. At the moment, Israel and Palestine, the situation in the Middle East is confined to the Middle East. It's not affected too much. Okay, oil had your pop higher when it first happened, but ultimately that's all we've really seen on that. On oil, oil's it's not got clear direction. It's not like it's ripping higher every day, and reason being is because no other countries have got involved. Now, if Iran or something was to get involved, fresh sanctions were placed on them or any of the other countries in the Middle East, oil-rich countries in the Middle East, then we can start to look at that as a bit more of a serious event. But right now, that's a serious event. That's probably the wrong way to put it. Obviously, it is an extremely serious event, but if we just look at it from a financial markets point of view, I can't imagine markets whip around too much off the back of if Israel go into Gaza. What we will see a rip around off, what we will see markets hack about on, is if other countries get involved. And that's the kind of simplicity you got to take with these things. Do other countries get involved? Yes or no? If they do, well then that should cause some moves. If they don't, it will probably just fizzle out. Markets will start to move past that. When we come to the grid and have a look at today, we can see stock indexes across the board. We can see the S&P, Dow Jones, Nasdaq, the Russell all lower. US equity futures lower across the board. European equity futures lower across the board. Asia Pacific equity futures lower across the board. Apart from the Australian stock index with the Australian dollar lower, the central bank governor pushing back on an interest rate hike does lend a bit of support to the Australian stock index, but apart from that, sea of red across the board. Bond yields higher, mainly higher. The US dollar higher as well. So stocks lower, yields higher, dollar higher. What we were calling for on Monday didn't play out Monday and Tuesday. Wednesday we did get the trade that we were looking for. The Australian dollar weak, Japanese yen weak, Aussie yen pretty flat. That's why you see both of these red across the board. They will chop in and around each other. Sterling is relatively weak, but not exactly massive moves across the board in FX, pretty small percentages. US dollar is the biggest mover on the day, and solid stock downside in today's session. So if it does continue heading into this European session, it will be a massacre across the board on stocks. Does it warrant a massacre just yet? That remains to be seen, but US 10-year yield rallying aggressively over the course of the back end of yesterday and into this morning. You can see here substantial move on a 10-year yield, reversing all of these losses from Monday. They are back towards the highs, hitting this 5%, which that point reached 5.02%, was the highest level the 10-year yield has reached since 2007. If we do get back up to there and break up through there, it does have widespread implications across markets. Dollar strength, stock index weakness is likely to continue if that reaches 5.02 and does go and continue. The 2-year yield chopping sideways but up yesterday, up in this morning's session, does have a solid resistance level to break, which will be support on the bond. If that breaks, you'd have to imagine it makes its way back up towards this 5.2%. But yeah, the curve bear steepening, right, the long end of the curve or should I say the long end of the curve steepening, which is a more normalization of the yield curve, which is interesting. The yield curve's been inverted for a while. The US, if the 2-year keeps subdued and the 10-year gets above the 2-year, markets will take that as a bit of a positive. So that's an interesting one. Shows the resilience in the US economy at the moment. And that is reflected in markets. You can see, I think that is Bank of Japan intervention. You'd have to imagine that hourly candle is not what I was anticipating. Yeah, you'd have to imagine that is the Bank of Japan stepping in over the course of this video. You come from the highs at 150.8, 149.8. It is only 100 pips, so is not as much as you may have expected, and has bounced straight away. So you'd have to imagine, I mean, is that intervention? They said this wasn't intervention back here, or Reuters said it wasn't intervention. Current accounts were pretty in line with expectations. So certainly not a size of move like that, but that is maybe potentially a start of a bit of intervention. So yeah, once I get off this video, we'll need to keep an eye on that to see if that does materialize in anything. Well, yeah, sorry, that's put me off a bit looking at it. Well, you can see the downside then in Aussie, Kiwi, Euro and Sterling over the course of yesterday. Dollar Swiss, dollar CAD, dollar yen, all pushing higher. The dollar index then pushing higher with it. The dollar yen back towards 150 and has sprung back higher. So US yields pushing all of these, or the current, I say all of these higher, but these four obviously lower, but pushing the US dollar higher across the board. You can see stock indexes, the S&P, the Dow Jones, the Nasdaq, the Russell, all lower. The Nasdaq heavily impacted by those tech stocks in Google, or Alphabet should I say, and Meta. So Nasdaq with the most aggressive downside rallies being sold on the stock indexes. Do you want to sell them at these lows? Maybe it's a bit of a tricky thing. Spike higher in the European session, sell back into them, maybe a decent bet. But this dollar yen chart, we're gonna have to keep an eye on it now. I'll get off this video. Keep an eye on that dollar yen chart. Does it move aggressively? You know, we've had intervention in the past. We got a good 500 pip move and a couple of hundred pips. What do we have the last time? You know, from the high down to the lows, good 280 pips. This has only been 100, a swing of 100. Is this people just closing out positions? I mean, if you look at this chart, the way it's moved, you know, there will be a lot of long positioning built up in there, maybe even some potentially left over from back here. So yeah, a lot of long positioning built up. That could easily be just a bit of profit taking in anticipation for the Bank of Japan. Ultimately, if they were going to intervene, you would imagine they would do it a bit more aggressively than that. So I'm not sure just yet. I don't think so, just judging by the size of the move. But the fact that has happened, let's keep an eye on it and see if that materializes. But at the end of the day, dollars higher, yields higher, stocks lower. What we've been expecting since the start of the week.